Okay, let's dive into something that sounds, well, kind of impossible. We're talking about a multi-trillion-dollar financial industry that's built on one simple rule. You absolutely cannot charge interest. So how on earth does a bank even survive?
Yeah, that's the big question, right? I mean, everything we're taught about banking is that they make money on the interest spread. They borrow money at a low rate and lend it out at a higher rate. So how could a bank possibly stay in business, let alone grow into a massive global industry, if you take interest completely off the table?
Well, the whole thing starts with one single foundational principle from Islamic law, or sharia. It's a concept called riba, and it strictly forbids earning money from, well, just from money. Plain and simple, no interest allowed. And this isn't just a suggestion, it is the absolute core rule that shapes this entire financial system.
So if interest is out, what's in? You can't just remove the engine of modern banking without replacing it with something else. Islamic banking has a completely different framework, one based on real-world trade, sharing risk, and some pretty strict ethical guidelines. Let's take a look at the rulebook.
Okay, so these four principles are basically the pillars holding the whole thing up. First, no interest means profit has to come from actual economic activity, like buying and selling something real. Second, and this is huge, risk is shared. It's not like a normal loan where all the pressure is on the borrower. Here, the bank and the customer are in it together. Third, every single deal has to be backed by a tangible asset, a real house, a car, actual equipment. And finally, all the investments get screened for ethics, so you won't find them funding things like alcohol or gambling.
All right, so with that rule book in mind, we can finally start to solve our puzzle. How do these banks actually make money? Well, it all comes down to a few really clever models that are based on trade, not lending.
The first, and honestly, the most common method you'll see, is called Murabaha. And the easiest way to think about it is as a cost-plus sale. Instead of acting like a lender, the bank acts more like a retailer or a middleman.
Let's just walk through a quick example. Let's say you want to buy a car. You find the one you want, and it costs $20,000. You go to the bank and tell them. So the bank goes and buys that exact car. It now legally owns the car. Then it turns around and sells that car to you for a price you both agreed on beforehand, say $22,000, which you pay back over time. That extra $2,000 isn't interest. It's the bank's profit margin on a sale. It's a trade, not a loan. It's a subtle but absolutely crucial distinction.
Okay, so the next model, Mudarabah, shifts gears a bit. We're moving away from simple buying and selling and into the world of investment partnerships. The core idea here is really simple. One person brings the money, the other brings the know-how.
So in this setup, you're the investor. You deposit your savings in the bank. The bank then acts like an investment manager, taking your money and putting it to work in ethical, sharia-compliant businesses. If those businesses make a profit, you both share it based on a ratio you agreed on from day one. But here's the key, the risk-sharing part. If the investment makes money, great, you both win. But if it loses money, you, as the person who provided the capital, bear that financial loss. The bank's loss is its time and effort that went to waste. So the risk is distributed.
Now, what if both you and the bank want to have some skin in the game? Well, that's where our next model, Musharakah, comes in. This isn't just a simple partnership. This is a full-blown joint venture where everyone invests together.
This is where that idea of shared risk and reward really gets balanced perfectly. Both you and the bank put money into a project, maybe a new business or a real estate development. You might even manage it together. If it's successful, the profits can be split however you agree. But, and this is the important part, if there are losses, they are always shared in direct proportion to how much money you each put in. It is a true partnership, through and through.
So, just to put it simply so we're all clear, with Mudarabah, think of it as one person's money and another person's work. The financial risk falls squarely on the person who put up the cash. With Musharakah, it's everyone's money in the pot, so everyone shares in any potential financial loss. It's a really key difference in how that risk gets handled.
All right, the last major method we're going to cover is called Ijara. And this one is probably going to feel the most familiar to you because it's actually really similar to leasing or renting. So, imagine you want to buy a house, but you don't want a traditional interest-based mortgage. With an Ijara contract, the bank actually buys the house. The bank is the legal owner. Then it leases that house to you for a fixed period of time. Your monthly payments are just considered rent, and that rent is how the bank makes its profit. And very often, at the end of the lease, you'll have the option to buy the house, making the whole thing function a lot like a rent-to-own agreement.
So, that's all great in theory, right? Those are the models, but how does this all work out in the real world? We're talking about a massive global industry here, and its very unique rules create some pretty unique challenges.
And when I say massive, I am not kidding. The global Islamic finance industry is worth over $2 trillion. This isn't some tiny niche market. This is a major player on the world economic stage, especially in the Middle East and Southeast Asia, and it's growing everywhere.
But it's not a perfect system by any means. A really big criticism is that some of these products, especially some of the cost-plus sales, can end up looking and feeling a whole lot like a conventional loan, just with different terminology. Another challenge is that there's no single global standard. What one country's scholars say is compliant, another's might not. And, at its core, there's this constant tug-of-war between sticking to strict religious ethics and the very real commercial pressure to run a profitable bank.
So, what's next? Where's all this going? Well, just like the rest of the financial world, the future is digital. We're now seeing this huge rise in Sharia-compliant fintech companies and digital-only neobanks. They're bringing all these principles of ethical, interest-free banking to a whole new generation right on their phones.
Okay, so we've gone through the models, the challenges, the future. What's the big picture here? What is the one thing you should really take away from all of this?
When you boil it all down, it comes to this. Islamic banking is a genuine attempt to build a financial system on a totally different foundation. By swapping out debt and interest for actual trade, partnership, and tangible assets, the whole model forces everyone to focus on sharing risk and participating in the real economy.
And that leaves us with one last question, and it's really a question for you. Now that you know how it works, that the profit comes from shared risk and real trade, not from interest, would you trust a bank that operates this way? Thanks for tuning in.